This news item was published on 16th of September 2008.
Lehman Brothers files for bankruptcy.
Lehman Brothers, one of the largest investment banks in the world, a bank founded in 1844, an entity that had managed to survive the American War of Independence, the crash of 1929, and the oil crisis had just failed. And do you know what the worst thing was? Nobody really knew why. You see, during those years, and particularly since 2002, the global economy had been experiencing one of its best periods of growth. Wages were getting higher, unemployment rates were near historic lows, and the housing sector was working flat out to supply new homes for all the young people entering the job market. Things were going smoothly and at full steam ahead, or so it seemed. Today, we know that, well, much of that bonanza was a lie. A lie that, at least in Western countries, was caused by a huge credit and real estate bubble that burst with the collapse of Lehman Brothers. Until then, however, this was far from clear. Virtually no one could sense the coming crisis, since after all, the economic news was better every year than the previous one. So, frankly, a bankruptcy like that of Lehman Brothers caught half of the world by surprise. It was as if overnight, a seemingly indestructible financial pillar fell like a domino that, as many of you already know, triggered one of the worst global crises in living memory. Well, what if I told you that history could repeat itself? What if I told you that a large European bank is aiming to follow in the footsteps of Lehman Brothers, potentially triggering a new financial crisis like the one in 2008? You don't believe me? Well, take a look.
Credit Suisse shares tank as capital concerns spark reminders of Lehman Brothers' failure. Credit Suisse and Deutsche Bank on the way to repeating the history of failed banks. These banks could become the next Lehman Brothers.
Just as it sounds. According to several international media outlets, both Credit Suisse and, to a lesser extent, other entities such as Deutsche Bank could be very close to bankruptcy. And take note, because if this is true, the financial collapse could be much larger than the one caused by Lehman Brothers. Why? Well, pay attention to the following graph. What you are seeing right now on the screen is the volume of liabilities managed by Lehman Brothers at the time of its collapse. This volume of liabilities is something like the total amount of indebtedness of the bank in question. So, the greater the number of liabilities, the worse the consequences of a possible bankruptcy. Well, now look at the volume of liabilities that both Credit Suisse and Deutsche Bank have together. We're talking about almost 4 times that of Lehman Brothers in 2008. In other words, the possible bankruptcy of these two European banks would be no joke. Their collapse would cause a financial crisis even worse than that caused by Lehman Brothers. Now then, everything we have told you so far, well, let's just say it's all rumors. These are potential problems that could happen, but that certainly almost nobody has defined exactly. Yes, the international media have gone crazy, warning about the possible cataclysm. But what is really known about the economic financial situation of European banks? Is a massive bankruptcy really imminent? Perhaps it will take some time to arrive, or maybe it will never arrive, and it's all just pure scaremongering. What are the real chances of one of these bankruptcies and an impending financial crisis actually happening? Well, VisualEconomik viewers, these are the questions we will answer in today's video. So grab your popcorn and get settled. This time, we'll get straight to the point. What is the big problem with Credit Suisse? And why are people suddenly so scared about the possible failure of this large Swiss bank? Well, how would you feel if I told you that the origin of this whole story is in tuna fishing? Yes, you heard me right. Tuna, the fish. I know, it sounds completely crazy, but, well, let me explain it to you. It turns out that back in 2012, both the Swiss Central Bank and the European Central Bank started a policy of low interest rates. Let's just say that after the financial crisis of 2008, the central banks wanted to shower the market with cheap loans for everyone. Loans that would boost the economy again. And this, for many people, was excellent news. If you wanted to buy a house, the mortgage was very cheap. If you wanted to start a company, the credit to buy facilities and equipment was almost free. However, on the flip side of such a binge of cheap money, there was one major casualty that no one seemed to remember: the commercial banks. Banks such as Credit Suisse and Deutsche Bank that since that point began to have serious problems earning money. Wait, what? Banks having trouble earning money? Impossible. Everyone knows that banks are real multi-million-dollar profit machines, right? Well, perhaps in other parts of the world this may be so, but the truth is that in Europe, at least in recent years, banks have not been particularly profitable businesses. As you can see in this graph, unlike what is happening in the US, while in 2008 the main European banks obtained a return on their capital of close to 15% per year, now they only obtain an average of 6%. Yes, they are still making money, it's not that they are poor, but to put this figure in context, one of Europe's largest supermarket chains, Carrefour, had a profitability of almost 11% this past year. In other words, a simple supermarket earns on average 80% more than the major banks in Europe. And Carrefour is not an exceptional profit case either, by the way. The question is, why did low interest rates stop banks from making so much money? At first glance, the answer seems easy. If interest rates are low, banks earn less interest on their loans. But the truth is that this answer fails to explain several things. For example, in the US, as in Europe, interest rates also fell to almost 0%. However, that did not stop US banks from making more and more money. In addition, lower central bank interest rates do not necessarily mean that banks will reduce mortgage or lending rates in the same proportion. Let's say, for example, that the European Central Bank lends money to commercial banks at 3% interest, and the commercial banks in turn lend that money to their customers at 5%. In this case, banks have a 2% profit margin for their services. However, if tomorrow the central bank lowers rates to 0%, as happened in Europe, banks can lower their lending to customers to, say, 2%. In this way, even if the rate at which they lend to customers is much lower, they will in fact still have the same profit margin. In other words, in theory, it does not seem that lower interest rates are necessarily a problem for banks. But then why was it precisely after the rate cut that European banks began to see their profitability plummet? Well, to a large extent, this happened for three reasons. The first is that, unlike in regions such as the USA or Canada, competition in the European banking sector is much more intense, which does not make it so easy to maintain the 2% profit margin that we gave as an example after a fall in central bank rates. The second reason is that after the 2008 crisis, regulations became tougher, and banks realized that if they did not clean up their accounts as soon as possible, a new crisis could come back and wipe us out for good. So in order to prevent misfortunes, banks used part of their capital to adjust and fix their accounts. Something that, for example, you can see in this graph, which shows how the percentage of non-performing loans on the balance sheets of commercial banks decreased rapidly over time. And of course, if you use your money to fix your accounts and not to lend it, then at the end of the day, you have less profit. But if we have to talk about the major reason that led European banks to fall behind, it was the lack of profitability of safe long-term investments. In other words, for those who don't know, banks typically use your money for three things. Either lend the money to citizens and companies, or they invest in liquid assets such as equities, or they invest it in safe long-term assets such as treasury bonds. That is, they lend their money to the governments of the world. So what is the problem? Well, the problem is that when interest rates fell, interest rates on treasury bonds also fell, among other reasons because the ECB was busy supplying the governments of southern Europe with banknotes. In fact, bond interest rates fell so much that lending money to governments like Germany even meant having to accept negative interest rates. In other words, it was no longer profitable for banks to lend money to governments, or at least not as much as it had been before, and therefore their profits were reduced. But take note, because this is where Credit Suisse and the tuna fishing we told you about earlier come into play. Since banks could no longer make as much money investing in treasury bonds or other fixed income assets, some of them came up with an innovative idea. They began to invest their money in new businesses with higher returns, albeit somewhat stranger ventures. Specifically, one of them consisted of lending money to the government of Mozambique to boost its tuna fishing sector. A bit odd, I know, but the point is that the Mozambicans promised to pay a very high interest rate, and Credit Suisse's management saw this as the perfect opportunity to scrape together a few extra dollars, both for themselves in the form of illegal bribes from the government, and for the entity in the form of interest. Be that as it may, the problem was that the Mozambican government had plans to repay the money by developing a natural gas installation in the country, but the development was never completed. The Mozambican government went bankrupt and never repaid the money to Credit Suisse. The result? Credit Suisse lost more than $1.5 billion between debt losses and penalties for bribes paid during the transaction. And this is just one example. After the tuna bond disaster, the entity accumulated more and more suspicious investments, with billionaire losses, and a lot of corruption scandals in the mix as well. Something that caused what you can see illustrated in this graph. In the last 7 years, amidst a lot of turbulent business and a declining banking sector, Credit Suisse lost money in 4 out of the 7 fiscal years. And as of the data making this video in 2022, it's already on track to accumulate its 5th year of losses. During the first 6 months of 2022 alone, the bank has already lost some $2 billion. By the way, it's worth noting that the Deutsche Bank's situation is quite similar. So I think outlining Credit Suisse's case is more than enough to get an idea of what this whole story is about. In any event, and having reached this point, there is a question that many of you may be wondering: why now? In other words, if European banks have been struggling for 10 years, and both Credit Suisse and Deutsche Bank have also been experiencing turbulent business and billionaire losses for years, why is the bankruptcy alarm sounding right now in 2022 and not before? Well, let's take a look.
When you hear the river.
You see, so far, every time Credit Suisse or other companies have had a problem, they have resorted to an old strategy that companies use to try to save their butts: Execute a capital increase. Basically, a capital increase consists of creating new shares and selling them on the market. In this way, the company manages to raise money to stay afloat, at the cost, however, of diluting the participation of the former shareholders. In other words, they lose money. You know, the more shares are offered, then the lower their value will be. In a way, it could be something like the equivalent of printing government bills, but transferred to the business world. Well, it turns out that a few weeks ago, Reuters released the following news.
Exclusive. Credit Suisse sounds out investors about capital hike.
In the aftermath of the war in Ukraine, the banking sector has once again suffered many complications. With rising interest rates and galloping inflation, some of the bank's assets, such as treasury bonds and financial derivatives, have suffered very worrisome declines in value. Meanwhile, as Russia has disengaged from the West and Ukraine is at war, all investments in the region have been written off. And as if that were not enough, the looming economic crisis threatens the banking sector with new defaults, a scenario that is very reminiscent of 2008. Well, faced with such a scenario, Credit Suisse is doing what it has always done to solve its problems, seeking capital increases, even at the expense of its existing shareholders. Of course, as expected, shareholders panicked and began to sell their shares en masse. As a result, Credit Suisse's share value plummeted by more than 27% in just 2 days. In addition, the price of Credit Suisse's CDs, which is a kind of default insurance for the bank's creditors, skyrocketed. To give you an idea, after the price soared, it meant recognizing a 28% probability that the bank would go bankrupt in the next few years. So just imagine, from then on, panic in social media networks started to take over everything. The media started to echo the scandals, and a lot of YouTube channels started to announce the return of the Lehman Brothers catastrophe. In just 2 days, it seemed that the world was facing its end. But beyond all these assumptions, the stock market falls, the soaring CDs, or the general alarm on social media, is Credit Suisse really on the verge of bankruptcy? How bad is its situation really? Should we fear that a new Lehman Brothers is imminent? Let's answer these questions, but first, take a look at this chart. You won't believe it, but more than 50% of the people who are watching Visual Economic are not yet subscribed to the channel. And the question is, what are you waiting for? Do you like economics? Do you like to know why some countries perform better than others? Maybe you're interested in knowing what inflation, wealth, or the success of political measures we see in the media every now and then depend on. Well, if you're interested in all of this, and you want to see more videos just like this one, then hit the subscribe button. And now, let's get back to those questions.
Beware the flood.
Do you remember one of the reasons why banks started to lose profitability starting in 2012? The second reason is that after the 2008 crisis, regulations became tougher, and banks realized that if they did not clean up their accounts as soon as possible, a new crisis could come back and wipe us out for good. Indeed, as we learned in 2008, crises can come unexpectedly, and fortunately, European banks have spent years doing their homework and preparing for a crisis just like the current one. What you're seeing on the screen is what is known as the Credit Suisse CET1 ratio. This ratio is, to put it simply, the way in which the financial cushion of an entity can be measured. It is something like the volume of capital available to withstand economic shocks. After the 2008 crisis, one of the regulations established was precisely that this ratio should always remain above 10%. In other words, for every $100 of risk-weighted loans, banks were required to have at least a $10 liquid capital cushion. As you can see on the screen, right now, Credit Suisse more than meets that requirement. In fact, it has a margin well in excess of the 10% needed to withstand potential losses. This is something that has not only applied to Credit Suisse, but other European banks have also been increasing their financial cushion volume. As you can see in this graph, European banks today have a much larger liquid asset coverage than they had in 2012. This will allow them to more easily absorb any economic problems that may arise. But as if these positive data were not enough, following the alarmism of Credit Suisse, and to a lesser extent, Deutsche Bank, both Citigroup and JP Morgan issued the following statements calling for market calm.
Citigroup analysts said they don't believe this is another 2008 moment. JP Morgan analysts similarly argued in a note on Monday that Credit Suisse still has healthy capital and liquidity, based on financial results from the most recent quarter.
As you can see, as mismanaged as the bank has been, this whole Credit Suisse scandal looks more like a shareholder and creditor panic than a real bankruptcy problem. Provided, of course, that the annual accounts are not manipulated, which we hope they are not. Be that as it may, if all of this is true, if Credit Suisse is in no apparent danger of bankruptcy, nor is it in apparently catastrophic trouble, why on earth are the managers considering a new capital increase? The truth is that after all the scandals, such as the tuna bond scandal, and after years and years of losses, a new team has now arrived at the board of directors of Credit Suisse, and among its plans to give a new direction to the company is to carry out a complete restructuring of its business model. And what happens is that in order to carry out this restructuring, the bank needs money, a lot of money. Keep in mind that we're talking about business structures comprising billions of dollars. It is not something that can be done in 2 days. So in order to raise all of the money needed, the board of directors came up with the idea of a capital increase, which, although well-intentioned, ended up unleashing chaos. Now, wait a minute, it's not over yet. Although Credit Suisse does not appear to have any real bankruptcy problems at the accounting level, this whole scandal could cause a banking panic. In other words, if the time comes when everyone thinks that Credit Suisse is going to fail, everyone will withdraw their money and investments from this institution, which, paradoxically, could put its survival at real risk. Come on, the perennial self-fulfilling prophecy. However, even if a banking panic were to occur, there is still one major player that could prevent disaster. Remember our video on the Swiss Central Bank? As we told you in that video, which I'll link for you in the description, the Swiss National Bank is one of the healthiest and strongest banks in the world, a bank that has become a true professional in the investment world. Well, unlike the European Central Bank, which has a balance sheet full of junk bonds from southern European governments, the Swiss National Bank could easily rescue Credit Suisse. In fact, in the midst of the storm, the Swiss National Bank carried out an operation where it borrowed more than $3.5 billion from the Federal Reserve to, according to some theories, support Credit Suisse. This support would consist of helping the entity to repay part of the money owed to its creditors, thus calming the alarmism about its possible bankruptcy.
Credit Suisse pays down debt to calm investors. It will buy back up to 3 billion Swiss francs of debt, an attempt by the Swiss bank to show its financial muscle.
In any case, and having seen all of this, the conclusions we can draw from this video are the following. 1. The first is that following the 2008 crisis, European banks began to earn less money, and some started to invest in somewhat risky businesses, which reduced their profitability. The second is that in spite of this, during the last few years, the bank's accounts have been getting healthier, and today they are much better off than they were in 2008, which will make it easier for them to withstand the problems of the new crisis. The third is that even in the event of a banking panic, or a situation even worse than the current one, at least in the case of Credit Suisse, the Swiss National Bank could avoid disaster, and in fact, everything indicates that it is already doing so. But well, having come this far, now it's your turn. Do you think Credit Suisse will continue its downward spiral with this new management? Will things get worse in Europe? And will the bank start to run out of the buffer that is protecting them for now? What would you do if you were a shareholder in one of these financial institutions? You can leave your answers in the comments. And of course, if you like the video, please like it, subscribe, and activate the little bell so you don't miss any of the following videos. And we'll see you in a future video here on Visual Economic. All the best, see you soon.